What we're going to look at is making an offer at 9.89% in this case, or 10%, then reselling it to an end buyer who's going to be paying somewhere around the 6 or 7% area as a cap rate. The three important inputs into this equation. First and foremost is the price. And what I've done here is I picked a price to get a 10% cap rate that we are going to pay the seller. Now I included $300,000 in repairs. There's 30 units. We figured $10,000 per unit repair expense, which is, let's presume the $10,000 a unit is average. Obviously you might get away with $1,000 or $2,000. Some may be no cost at all. What I'm trying to do here is get the lowest possible cost basis for us when we make the offer at 10%. So the unit's 30 times $900 is $27,000 a month. You'll notice here it says units 1 through 5. That's for a multi-unit with 5 units or less. But you can use this to put in 30 units, $900, $27,000 gross monthly rental income. Annual income is $324,000. The third part of the equation, so to speak. First part's price you pay. Second part's the income. The third part are the expenses. You choose a vacancy rate. I've chosen 6%. That's kind of standard in the industry. That automatically comes out to $19,000. Insurance, I picked a number, $12,000. Management company, I chose 10%. You can use any number you want. Any yellow cell can be changed. Any other colored cell is automatically calculated and frozen. Repairs budgeted $7,500. Remember, I put in $10,000 per unit up here. Taxes, $40,000. That's based on about 2 to 2.5% of the purchase price, but it's a fill-in number. If you find out the actual taxes on this property, which are in the public record, are $24,000, you can plug that in. If they're $50,000, plug that in. And I threw in a number for miscellaneous expenses. Now, there could be another source of income, and that source of income could be and should be a laundry room where you have tenants who do their laundry. In these units, they do not have washers and dryers, so the tenants either have to go out to a laundromat or they have to go downstairs wherever and use your coin-operated laundromat. I'm not including that in the income side. With these numbers automatically calculated is the cap rate. If we add in the expenses that we expect for the estimate of repairs, it's 9.89% cap rate, which is pretty close to the 10% that we want to offer to the seller. So the offer price that we would make the seller is the purchase price minus the repair expenses that we're estimating, which would come out to the 9.89%. If we in fact change this amount to 0 and just made the offer, what we'd be offering him is 11.58%. which may be acceptable depending on the motivation of the seller. What we're going to do for now is leave that 300 there, and we're going to offer 1.75 minus 300, $1,450,000 would be our offer to the seller, and we can show him that we have a cap rate of 10%, which in this case the seller said he was willing to accept. Built into the calculator is the ability to change these numbers. For example, when you go to sell the property, one of the things that the new buyer is going to look at is what's the current rental income, but more importantly, what can I raise the rent to? Because I'm going to come in and fix it, raise rents, have a higher value, and then resell it or refinance it or whatever. So let's look at the rental income at $27,000 a month. Let's raise the rental income very simply to $35,000. If you notice what the cap rate is, if we're offering the money, would be 13.82 because we're subtracting the repair cost. Let's take out the repair cost because your buyer is doing this now. So based on the same expenses, what we're going to do now is reoffer this property to an end buyer who said, I'm willing to pay a 6.5 cap rate. First of all, he's going to have his own estimate of repairs. We're going to take out the repair estimate and we're going to put in a new number. How do we know what number to put in? This is called a convergence. What we do is we put in a number, in this case $2.5 million, and we see what the cap rate is. As you can see here, it's 8.11%. So we're offering him for $2.5 million, the same property with the same income, same expenses, and it's way above what he wanted. So let's go a little further. At $3.5 million, we're almost at a cap rate of 6%. And I'm going to do one more silly thing here and offer $3.25 million. Lo and behold, the cap rate is 6.25%. He said, I'm willing to take a property at 6%. The beauty of this property is he's going to look at it and say to himself, okay, what I'm going to do is increase these rents to begin with to $35,000 a month. His cap rate just went up by 2 full percent. His net annual income increases dramatically also. But let's go one step further. So what I've done is I've picked a number now of $3 million. And at $3 million, the cap rate to the buyer is 6.76%, as you can see. What that means to us as a wholesaler, we bought something for $1.45 million, sold it for $3 million, and the spread in between is our profit on the transaction. Now let's assume for a minute that despite the fact that he said he would take 6%, he now comes along and says, no, I'm not going to do that. I'm not willing to pay more than $2.5 million. Well, that's an 8% cap, but $2.5 million less our $1.5 million as a round off is still a $1 million profit on the transaction. Now, how many times do I see the transactions where the profits are 200, 400, 600, a million, 2 million, ironically more often than you would think. So here what we've done is we've gone to the original seller, fulfilled his wishes. He wants out. I don't have to give you reasons for why people are motivated sellers, but that's what we offered, what he wanted. What we did is we then resold it to an investor coming in who looked at it as, I can increase rents, I can decrease the management fee, I can decrease the vacancy rates, all of which will be more money to him. For example, let's look at what happens if we go to a 5% management fee and we decrease the vacancy rate to 3%. Now he's at 9%. And if he does do what he says he can do with increasing the income, he's at 12.5%. If he does these things, he's going to be able to wind up selling it to somebody else for, guess what, $3.5 million, and they're going to get a 9% cap rate. How feasible is this? Very. How often does it happen? More often than you would think, typically for reasons of probate, a severe illness, tired landlord. So that's an overview of how to use the rental return calculator, just the first section of it, to calculate a cap rate at both the purchase price, which is a higher cap rate, meaning a lower price, and to resell it at a lower cap rate, which means a higher purchase price.